So number one, first and foremost, what is depreciation? Well, it's the IRS saying, look, you've got this house here, right? You bought this house, could be anything, could be an apartment complex, could be a commercial building, could be a single family home. But today we're going to talk primarily about single family home because that's what I primarily buy. Okay. So I buy a single family home. And let's say that the median household price of most homes are probably around $250,000. But what's going to happen, actually, I'm going to make this really simple for math for you guys. Okay. I'm going to say that this is $275,000. Okay. $275,000. What's cool is the IRS says, look, we think that all properties every 27 and a half years, somebody's always going to ask, where does this 27 and a half years come from? The 27 and a half years comes from the IRS. It's an algorithm they put together. And they say that after 27 and a half years, you will have to remodel 100% of that home. And essentially, that means that you can write off 100% of the value of the home when you purchased it over the course of 27 and a half years. Where does the 27 and a half years come from, guys? The IRS came up with that through an algorithm of their own. That's all I know. That's all any CPA has ever been able to tell me. That's where the 27 and a half years comes from. So what's cool is that you can do straight line depreciation. Let's talk about what depreciation is. It means I can take a portion of this purchase price or what the value of the home was when I bought it. And over 27 and a half years, I can take 100% of that value against my income, right? As a write-off. So let's say year one, I get how much money? Let's take it. Somebody divide. It's very simple. Now you'll know why I did the purchase price of $275,000. The purchase price is $275,000. Type it in your calculator and divide it by 27.5. Very simple math. How much money? Edgar Trigos is never on the market value. The depreciation is always on your purchase price plus what you immediately put into the property. Okay? So the IRS is going to give you $10,000 on straight line depreciation for 27 and a half years. So what that means, so pay attention to this. This is why this is beneficial. So that means I can go over here. Let's say there's Pace right here, and Pace owns two businesses. Okay. One is he has one rental property that's worth $275,000 in one business. And then he also has a wholesale business where he only does one wholesale deal every single year. And his average wholesale fee is $10,000. Well, what's cool is I would normally have to pay taxes on this $10,000, right? And because of all my other businesses I own, right, all over the place, my tax rate on that $10,000 would probably be about $4,300 in real taxes. That's cash that would leave my freaking pocket off that $10,000 assignment fee. Okay. So when you guys are out here trying to wholesale, pay attention to this because you have taxes. Every time you get an assignment fee, you have taxes that you have as a burden. But what's cool is because I went over here and I bought this house right here, subject to or seller finance, because you're an idiot if you do the BRRRR. I bought this subject to or seller finance. Guess what I get? The IRS gives Pace a credit of negative $10,000 for that property. Remember, where did the $10,000 come from? It came from this. I bought the house for $275,000. The IRS will give me a straight line depreciation for 27 and a half years. So I took it and I divide 275 by 27.5. And there's my magic $10,000. Guess what? That means every year for the next 27 and a half years, I can wholesale one property and pay $0 in tax because this $10,000 depreciation credit goes against my $10,000 gain. And therefore, in the IRS's mind, I made how much money? I made $0.00. Therefore, there is no ability to tax that $10,000.